This is the debrief of drafting and interpreting financial statements, AAT Sample Assessment 1, Task 6. And in Task 6, we are being judged on how we interpret financial statements, and that includes the calculation of ratios. So in this particular question, we're given the statement of financial position of the business, as well as their statement of profit or loss, and we are asked to calculate 4 different ratios. The first one is return on capital employed. So return on capital employed is calculated using the operating profit of the business, and we divide by the amount of capital that has been used in the business to generate that profit. And the capital employed can be looked at in a couple of ways. It's either the combination of equity, so that's the long-term capital injected into the business by the owners, but also any non-current liabilities, because that's capital that's being provided by external parties. Or another way we can look at this, remember in the accounting equation, assets minus liabilities equals capital. So we can also look at that as total assets minus current liabilities. So yeah, it's either a combination of equity and non-current liabilities, or it's total assets minus current liabilities. Okay, so either way will give you the number for the denominator on the bottom of the calculation. So in this particular case then, we want our operating profit, and there we are, we're given the 5894, and we want to divide by capital employed, that's the total of our equity and our non-current liabilities. And if you divide those numbers, we get an answer of 6.7%. Now notice the question said specifically it needs to be to 1 decimal place. So the computer is marking your answer here. So if you put it to a different number of decimal places, then the computer will not recognize your answer and you will not score your mark. So it's really important that you follow the instructions given to you in your assessment. The second ratio required is the current ratio, and this is the total of current assets divided by current liabilities, and it's helping us to understand whether we have enough assets that should turn into cash in the next 12 months to be able to pay off the liabilities that are due in the next 12 months. So we have our total for current assets, we have our total for our current liabilities, so we just need to divide one by the other, and that gives us an answer of 2.3 to 1. The next ratio is our inventory holding period, or inventory days, and that's calculated by taking the inventory and dividing by our cost of sales. And remember, we're dividing by cost of sales because that's how we're going to be utilizing the inventory, isn't it, as we sell those goods. And then we multiply by 365, the number of days in the year. So we have our inventory value and we're dividing by cost of sales. So if we take the 2817, divide by our cost of sales of 19,154, remember we're multiplying by 365, the number of days in the year, and then that gives us an answer of 53.7 days. And finally, we're asked to calculate the interest cover. So this is calculated by taking our operating profit and dividing by our finance costs. And so notice that we're using the profit figure that appears before we pay that interest. Okay, so we just be careful with that because some people use the profit after paying, but we want to know, do we have enough profit to be able to cover those interest costs? So our operating profit, we have 5894. We're dividing by our interest, and that tells us that we have 5.1 times profit to be able to cover our interest, which is good.